Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Layton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Layton Kling. Coming up on today's show, it's a lot of e-commerce, actually. We're not used to that. Not as much brick and mortar. We have to talk about Prime Day. That's our obligation as a retail podcast. We'll also talk about Chewy. They had their first earnings released this week. And we'll discuss later on in the show RentACenter as they make a surprising move to perhaps keep pace with Aaron's in the rent-to-own retail space. A reminder, you can check us out on Twitter and Instagram at Retail Podcast. We're also on any podcast listening service you might desire. So if you find us there, please like us, rate us there. That includes Spotify. We are on Spotify as well as all the common ones, iTunes and Podcast Addict. I suppose it's Apple Podcast now instead of iTunes. Either way, if you find us there, please like us, rate us. That helps us out, helps us to get better, also helps the show out as a whole. So once again, we lead with the event everyone has been talking about this week, Prime Day. And honestly, although it was a big retail story this week, probably wasn't even the biggest story related to Amazon this week. A lot of stories tying, of course, Amazon with federal government initiatives. We'll leave that behind here, but as with every year, we don't really want to be talking about Prime Day because oftentimes the headlines are the same each year. We know workers don't like it. We know Amazon sets sales records. We know other retailers benefit. We know there are sporadic system outages and IT issues. But this year, we did see some interesting takes on Prime Day from other news outlets, particularly Yahoo. I thought this was interesting. Layton, Yahoo covered the fact that many Prime Day shoppers actually elect to have the packages sent to their workplace because of convenience or out of fear of porch pirates. And according to the study they cited, only 46% of employees pick up their packages on the day they're delivered. So causes some workplaces to have a massive backlog of parcels for the employees to pick up. Clogging their mailroom in the process makes it difficult, but still, with all the records set and the extra long length this year, we wanted to focus on something we've been talking about since a study we discussed last year, suggesting that Prime Day has an outsized impact on retailers besides Amazon.
Yeah, the latest study comes via Ad Age and Adobe Analytics, which shows the sales were up even more this year at non-Amazon retailers, something Trent just alluded to. Over the 48 hours of the event, retailers outside of Amazon saw a 68% increase in sales. The study was limited to retailers with annual revenues in excess of $1 billion. So these are going to be larger retailers. And to take out some of the numerical volatility experience with some of the smaller retailers out there, this is meant to give sort of the larger picture view of what was going on. This is up from last year's 54% pop, according to Adobe. It was a function both between better conversion, 46% better, and visits and traffic. That was up 49%. Adobe ran a similar study for retailers with revenue less than $5 million yearly and found a 28% increase in online sales this Monday as compared to an average Monday. This includes retailers who did not run sales or promotions, with one small brand's CEO quoted in Ad Age as saying that perhaps people were just in the mood to shop. Not really giving any reference to Amazon there, but Retail Me Not, another company we look for analytics and research, found that around 300 retailers had their own Prime Day offers going on. So really trying to take advantage of the higher traffic online and e-commerce. And you look, this is higher than their estimated total of 250 retailers. And digging deeper, they found a number of brands used Prime, Black Friday, or Cyber in their messaging. So that advertising really trying to take advantage of those particular buzzwords. J.Crew was noted as one of these in the article. They use Prime Time Event for their messaging. Some retailers went even further, offering week-long deals in a shift from the traditional model, similar to what we've seen now surrounding Black Friday. One of Amazon's prime competitors, pun intended, is eBay, who released earnings this week as well. The earnings were positive for eBay, who saw a significant pop in share price immediately after the call, only to see it decline back to pre-call pricing levels in trading on Thursday. The positives center around eBay being more profitable and some rumors that they'll see alternatives for StubHub. their subsidiary. The negatives center around gross merchandise volume, which was pretty well even year over year, despite an increase in customers by around 2% for the company. Morgan Stanley's model shows a potential drop in gross merchandise volume of around 5% in the final 2 quarters of 2019 and just a 1.5% increase in the US for 2020. Despite all this, analysts generally raise their price targets after the call. eBay has a lot of ground to make up. We tend to think of their current advertising campaign, a good one, but they need to be more aggressive with it overall. Other analysts were quoted this week as saying that they felt their ad campaign needed to be changed to more aggressively target Amazon, although we think it does sufficiently target Amazon, but leave that up for the analysts to decide. As far as Amazon's Prime Day results themselves, well, they were very good once again. And this was interesting, Trent, because I am on our Twitter account. You can find us at Retail Podcast. And to be honest with you, it just did not seem as big as it was this last year. But apparently, sales-wise, it did even better. So Prime members bought 175 million products in total. Granted, this is across approximately 100 million Prime memberships.
So quick math tells you 1.75 items per Prime members. But again, the big headline for Amazon this year was that it was bigger for Amazon than Black Friday and Cyber Monday combined. So bigger for that company, maybe not bigger than other companies, Black Friday and Cyber Mondays combined. Perhaps, though, even bigger than this for Amazon is that they supposedly added more Prime members during this year's event, during 2019, than any other Prime Day in the past. So that tells us, as a recruiting tool, certainly appears to be working for Amazon. Amazon's own press release trumpeted that members also saved at Whole Foods during the day, and that Whole Foods' best-selling Prime Day deals were strawberries, blueberries, and cherries. And you kind of got the feeling from this year's Prime Day, as you do from many of Amazon's retail initiatives, that Whole Foods is kind of that thing that they're obliged to bring up and obliged to include to try and start drawing sales northward. You wonder long-term, though, if Amazon isn't going to start second-guessing that Whole Foods purchase because, again, a lot of times in the press release, it'll be mentioned something along the lines of customers saved millions of dollars at Whole Foods with their Prime discounts, but not a lot is talked about in terms of Whole Foods' actual revenue. And granted, Amazon isn't the most transparent company to begin with when it comes to revenue numbers from their retail division, but again, you really have to wonder where revenue is at for Whole Foods. They're not in expansion mode or anything. And a lot of the synergies that were touted when they first bought Whole Foods don't seem to be really prevalent outside of kind of wrapping them into some of these Prime Day type sales or other initiatives that Amazon has. Now, another big mention for them during the press release came from Bezos himself, saying that Prime customers bought $2 billion worth of products from small and medium-sized businesses that were fulfilled by Amazon. Again, looks like a little bit more of a PR reach, but they're embracing the fact that they're more of a fulfillment company now than anything. We talked a month ago about how Amazon is selling more products from independent retailers or other retailers than they are from themselves. This was brought up again in the press release, but also you figure they kind of threw that out there for that positive PR as though they're helping smaller, medium-sized businesses, which, again, you could make the very real argument that they are, and a lot of these businesses wouldn't have that type of platform. But again, kind of struck me more as a PR move than anything to include that in the press release. Now, as far as Amazon's own bestsellers, those were the Echo Dot and the Fire TV sticks. Now, I had a Fire TV stick for a long period of time, switched to Roku after 3 years of frustration, so maybe the new Fire Sticks have gotten rid of all the bugs that completely enveloped the old Fire Sticks. But generally, devices that mine our data, otherwise known as smart home devices for the non-cynical, were bestsellers. Ring and Blink devices and Amazon's Smart Plug also selling in vast quantities. Now, before we get too carried away about the Prime Day numbers, though, we should remember that Walmart, said to be one of Amazon's largest competitors in terms of nationwide retail in the U.S., they bring in an average of about $1.4 billion in revenue per day. So according to the larger numbers for Prime Day, Prime Day for Amazon's retail businesses pretty much amounted to the same thing as a good weekend for Walmart. So it's always important to kind of keep those numbers in perspective. Was Prime Day great for Amazon? Yes, and it seemed as though they had a lot fewer technical issues during this Prime Day, which is also kudos to Amazon for that, and kudos to their IT team for that. But as Layton mentioned, it didn't seem that there was a lot more buzz around this year's Prime Day, and you wonder if the increase in sales was due to, of course, the larger period of time that Prime Day was held over, but also just the general organic increase in sales that Amazon has seen over the past year. So kind of wonder where exactly those benefits are coming from for Amazon. But again, another Prime Day, and I'd call this one still a successful one for Amazon.
Trent, just a little bit off the record here. Are you still a Prime Day member?
So I am an Amazon Prime member, yeah, and I don't do a ton of shopping on Amazon overall. I probably buy 1 to 2 items per month. My spouse, however, buys many more items using the Prime mechanism. One thing that's also beneficial is for some of the other enterprises that I'm involved with, it can be easier sometimes to get things via Amazon Prime just from a logistics standpoint than to get them shipped in via other mechanisms too.
Interesting. I apologize. I just said Prime Day member. I meant Prime member, of course, but I canceled my membership around this time last year. Have not really had an urge to use it since the cost-benefit analysis just doesn't work out. But I do feel as though maybe I had a little bit of fear of missing out, so I was kind of perusing the sales over this last week, but just nothing really caught my eye. And to be honest with you, again, a little bit surprising that they had such a successful event, given the fact that there was not a lot of media coverage there like there was last year. Still a ton of media coverage, just didn't feel the overall aura that I had felt last year. Moving on to our second story with online pet supplies giant Chewy as they release their earnings this Thursday. After the bell amidst negative expectations, Zacks consensus estimates had Chewy losing 6 cents per share in their first ever earnings call. However, after their recent IPO, Chewy's market cap had stabilized around $12 to $13 billion prior to the call. There was general bullishness surrounding the IPO, with shares initially priced at $22, surging to $36 at that time of its first trade on June 14th. We should recall that PetSmart is still the majority shareholder of Chewy, or really PetSmart's private equity firm. They control around 70% of the outstanding shares. However, PetSmart still cashed in big on the IPO, selling around $800 million in stock. You see, this would, in theory, provide much needed liquidity to PetSmart, which some insiders have said is struggling to drive traffic even amidst a surge in pet-related buying, something we talk about often in terms of a big retail trend. To that point, the trend towards increasing spending on pets is still very much a thing in the United States, and we're going to go through the numbers here real quick, but the American Pet Products Association still estimates that a 3.9% increase in spending on pets is going to happen this year, far outpacing inflation. Of this, 25% is expected to be on vet care. Of course, it's a very expensive component, but with the rest surrounding food, grooming, and of course, pet supplies, one of the topics here with Chewy's IPO. According to Chewy's IPO materials, they bought in around $3.5 billion in sales last year, which was up 68% from the prior year. So they've been doing very, very well. One of the reasons, by the way, that they've actually bandied about the idea of an IPO in the first place, because sales were coming in so much higher year over year. Still, when one looks at their current market cap and compare it to revenue, the share price looks an awful like a potential bubble, around 4 times sales, to say nothing of the earnings. And so you look, Chewy's own expectations are to see a sales increase of 45% in this year's first quarter over last quarter, which is $1.1 billion in total. Additionally, they expect subscription sales to pop 55% to $744 million. However, our concerns for the retailer heading into the call were really centered around costs, especially distribution costs, Trent. Pet food as a whole isn't the most effective thing or efficient thing to distribute to stores, much less to home. So you're really thinking of a different model here with pet food and pet supplies, and their free and reduced shipping deals on things like 50-pound bags of dog food are sure to eat away margins.
Now, all that said, let's go ahead and get to those numbers. Layton talked about the expectations, and those expectations came from their preliminary first quarter earnings during their IPO process, so nothing comes as too much of a surprise here. Most analyst expectations were within a penny or two on a per share basis. Now, as far as that bottom line is concerned, Chewy did show a loss, in fact, a slightly greater one than expected. The loss came in at 8 cents per share versus those Zacks consensus estimates of 6 cents per share. Now, those losses overall at $29.6 million for this year's first quarter, much less than a year ago in the first quarter, $51.5 million last year. So they went down from $51.5 million last year to $29.6 million this year, and that's good to see, even if it was expected. Top line revenue came in at $1.12 billion, right around where their expectations were sitting, and again, that does reflect growth of 45% year over year. By the way, those numbers almost exactly what's expected both on the revenue and the growth front for the second quarter as well. Because of their subscription business and also because pet supplies don't often carry with them the same seasonality of other forms of retail, pet store revenue is fairly steady from quarter to quarter. We don't see that oftentimes in general merchandise retail or in grocery retail, some of the other staple goods retail sectors, but it's certainly the case with Chewy. And they actually mentioned this on the call when prompted by an analyst question about whether the fourth quarter was going to come in a little bit heavier. They said, hey, we've got our subscription platform that we're really building out. And because of that, pets have to eat all the time. It's not like they eat more around Christmas or more around February or something like that. Pets eat all the time. And so when you're talking about pet food, when you're talking about pet supplies in general, those are going to be in demand pretty much the entire year around. It's not like when you think of humans consuming food, you get those parts of the year like July 4th or like Thanksgiving or like Christmas where we turn into gluttons surrounding those holidays and we buy a little bit more from the store because there are some larger gatherings going on. Now, all that being said, the stock did pop slightly in after-hours trading on Thursday after the company released higher than expected expectations for second quarter revenue. So the idea that second quarter revenue going to be in line with the first was a little bit higher than expected for analysts that were on the call. And for a company immediately post-IPO that's in a growth phase, the expectations and those numbers that are set for future quarters far more pertinent to market reactions than a beat or miss on earnings would have been. Yeah, it would have been nice to see them beat on earnings, but in this case, analysts much more concerned about the future numbers. And so you saw a little bit of a stock pop after Thursday's call in after-market trading on Thursday. Now, we watched it through intraday trading on Friday. We're recording this podcast on Saturday morning, and the stock did decline mid-single digits because of a little bit of bearishness just surrounding the overall financials on the call, as well as some other macro factors. The market as a whole was down on Friday, but Chewy's upward revisions took projected second quarter sales to the neighborhood of that $1.12 to $1.14 billion that we mentioned the first quarter came in at, again, above analyst estimates for that. FactSet, for example, had the top range of their revenue at $1.12 billion for the second quarter, so they're projecting it a little bit higher than what FactSet had. They also increased their full year outlook to $4.6 to $4.75 billion. The result of this, in addition to the share prices going up slightly on Thursday before going back down on Friday, was a slew of articles in the moment right after the earnings call stating that concerns about overvaluation had been allayed. Now, that wasn't necessarily the case in some of the news articles you saw Friday, but again, a lot of articles coming out after their earnings call on Thursday saying, hey, maybe the company isn't overvalued after their stock popped so much after the IPO. Now, that part, in terms of the overvaluation, we aren't so sure about. After all, increasing revenue is great for sure, but the key is making a profit on that revenue. And for that, Layton, you and I went to the earnings call. I was on the call. I know you read the call transcript afterwards. And weirdly, a lot of the first part of the call was focused on around telling what they call the Chewy story and talking about general bullishness surrounding pet retail sales in the U.S., By the way, in this section, they mentioned that they call their employees Chewtopians, which kind of makes me want to kill myself. That sounds awful. I also thought about killing myself at the 100 plus mentions of pet parents during the call, which is better than the term fur babies to refer to the pets, but is still very awful to have to hear pet parents so many times during the call. I don't know why that irks me so much. Maybe it's just because I'm a reluctant pet owner and I don't really think about it as a parent type role. But Layton, I know you're a proud pet owner, and so you were probably happy to hear the term pet parents on the call. But of more substance on the call, what else did they mention, Layton?
Yeah, Trent, I do actually have a new cat, and she is probably the best pet that I will ever have. But I don't consider myself a pet parent. Both of those terms, pet parent and fur baby, they are awful, and you should want to kill yourself upon hearing them. Of more substance on the call, like you said, they mentioned this is the 1 year mark since launching Chewy Pharmacy and an automated prescription fulfillment system. And this is a market that a lot of analysts have been talking about for quite some time. Such a huge opportunity there for the prescription market in the pet category, trying to capture part of the vet care slice of the pet spending pie, if you will. Because of the demand surrounding their pharmacy services, they opened a pharmacy located with their Phoenix distribution center. The location makes sense because of the company's obvious ties with PetSmart and the fact that PetSmart is, of course, headquartered there. Being an e-commerce pure play, they spent a good amount of time focusing on their app and app improvements. To this point, customers have had difficulty tracking shipments through the app, which is something that Chewy is working on, including notifications regarding when shipments are going to actually be delivered to your home. There's an additional app improvement or development that's in the rollout stage 2, including the ability to search by scanning a product barcode and other search assistant tools. We've all heard of these same tools, but things that are new to the Chewy app. As a result, the continued app adaptations have really seen their app ranking. Currently, they have a 4.8 rating in the Google Play Store. However, some items on the call were a bit contradictory. They talked a lot about making big, bold bets, but at the same time, they wanted to make sure that they took a highly disciplined cash flow management approach through all of their actions and said that cash flow would serve as a governor for sorts of growth. And honestly, Trent, you can't have it both ways, but these are the types of things you hear right after an IPO. So it is curious to us to see which one really takes over. These two models, while not polar opposites, are pretty far apart ideologically. By definition, bold bets are those having higher risk, high reward. In business, bets that have low risk, high reward aren't really bets, but sound decision making within your internal business strategy. When discussing customer flow, as far as attraction and loss of new customers, there were some interesting things noted. The attraction of new customers part is pretty straightforward. Convenience and service with both mentioned. However, when talking about the loss of customers, their CEO, Sumit Singh, said that there weren't many signs that were insightful to discuss. We found it to be the opposite. And he said that the primary reason a customer will separate from Chewy is that a pet may pass away. However, he said that this separation is often temporary, as their data shows 80% of pet owners will purchase a new pet within 6 to 8 months of a first pet's passing. So in theory, the customer will be a customer again. In this way, the separation just isn't temporary, so it is important for Chewy to retain marketing while also being sensitive to the issue at hand. Secondly, he said that sometimes customers will leave Chewy because they have a pet store literally right next door, and the convenience proposition actually lies with the brick and mortar space in this case. And so this isn't something we hear e-commerce operators admit, but it is very, very true here, and a reason why the residential-backed brick and mortar Pet Supplies Plus and PetSense stores seem to be working out so well and have been so profitable as of late.
Now, strangely, the reason why we went to the call was to find out about future profitability, and it wasn't until the 6th analyst on the call that profitability was even breached. Credit to Brent Thill of Jefferies for this. And this is the million-dollar question. Can they compete on price and shipping with Amazon, all while building margins? Now, Singh said that basically they're looking to a path to profitability through 3 different vectors. The first is continuing to build on existing customer relationships so as to capture larger share of wallet with existing customers. Even an incremental gain here should generate a meaningful boost to profitability. Still, this is something that every retailer feels as though they can do. The second is continuing to build out healthcare and prescription services and building out private labels. Now, they mentioned their private label penetration is only about 5% currently. For most mature pet supply stores, it's about 15%. So the more they can build out those private labels, the more they can increase those margins and focus on wide margins there. Now, in terms of healthcare and prescription services, that was mentioned constantly by the call. It seemed like every analyst question that was asked on the call of Sing was answered with a reference to healthcare and prescription services. Now, the third different vector they're looking to a path to profitability through, and this is an initiative not yet underway, it was a vaguely worded idea to build the destination for pet parents. And that's a direct quote from the call, specifically as far as services are concerned. Still, they feel as though margin improvement overall that's seen so far this year will continue into the next few quarters, potentially building that ability to generate a profit through their existing business model, even if they don't make marked differences in that second and third vector. But that third vector, though, the services build out, that's really the elephant in the room. So many current pet stores, even those said to be struggling, like PetSmart and Petco, derive high value from high margin services, like grooming, for example. Is there any way for Chewy, or any e-commerce pet retailer for that matter, including Amazon, to do this effectively? So what does this look like in the future? Does it mean partnering through existing private practices through maybe a licensing deal or a franchising deal? Now, this is, along with shipping costs, which weren't really mentioned a lot on the call, and also margins on staple products, a big question to answer if Chewy is to be a longtime player. They did, by the way, address distribution. They just opened a new distribution center in Ohio and mentioned that on the call. They want to continue to build out their distribution network, but they didn't release exact plans on what that's going to look like as they effort to cut back on those shipping costs, to cut back on some of those other ancillary costs in terms of fulfillment to customers.
It's that time in the show when I talk about stem cells, and yes, I received them myself. I went to a stem cell facility located in Medellin, Colombia called Accelerator. Accelerator is the global leader in stem cell therapy. I went there personally because I had a knee issue and an ankle issue. And Trent, I have an update for you and our listeners. I am feeling much better. I actually felt better immediately, but I just wanted to make sure that it wasn't some sort of placebo effect going on. But my overall health, I feel very good. My quadricep tendonitis in my knee, it's progressing well. And this is something that can't heal overnight, so stem cells can't immediately address it. But the idea being that it can cure chronic ailments over a period of time. And I think that's exactly what's happening. I feel better. I feel more mobile, which is good because I plan on playing tennis later this afternoon and hopefully doing better than average. But Accelerator currently offers treatments for everybody for a variety of conditions, ranging from orthopedic injury, spine and disc injury, chronic pain, and even severe autoimmune disease. Accelerator has also something for everybody out there who's really looking to stay in the game. If you're maybe an athlete or you just do sports recreationally, trying to feel young and stay young, be youthful. I will be tracking my progress, continuing onward with this different sort of therapy in the future and letting all of our listeners know how it has been going. And to be honest with you, Trent, it has exceeded my expectations overall.
Now, if you or someone you know suffers from a life of pain or complications due to a major medical condition, you can join others like Layton and contact Accelerator. Start your path to wellness and become a BioX man or a BioX woman today. www.bioaccelerator.com/The Retail Focus Podcast and tell them Layton sent you. That's BioXcellerator, bioaccelerator.com/The Retail Focus Podcast.
Our final story has to do with the rent-to-own space as RentACenter makes a move to acquire a lease purchasing service. And this is interesting because this seems to be a big thing in the industry now. This seems to be the latest step in the battle between Aaron's and RentACenter to provide third-party services to a lot of people outside their immediate store footprint. And so it should also help to vertically integrate platforms within RentACenter, better allowing them to scale these types of services. Of course, in theory, now RentACenter isn't a retailer we talk a lot about on the podcast. We've covered a couple of their most recent earnings calls, but aside from that, don't really discuss this space. We've only brought them up in comparisons to Aaron's in the past. However, it's been a turbulent past year for the rent-to-own retailer with around 3,000 locations in the United States. And looking back to last year, Trent, the company accepted a buyout offer that some saw as being below market value. The buyout offer ended up falling through this last December. However, anytime you see a deal of this magnitude fall through, as in the case of Rite Aid, for example, it causes significant organizational flux, and it makes you scratch your head as to exactly why or what specifically in the due diligence period came about to make the buyer step away. The offer was for $15 per share in cash made by Vintage Capital last year. And if you look, Trent, the press release announcing the CEO of RentACenter saying that the deal had maximized value for shareholders at the time. So you saw that executives of both teams were on board for this, really excited for the shareholders or the overall value proposition that was given through that $15 per share buyout offer. The breakup was somewhat messy. Vintage Capital did not tender an extension notice by the deadline in December. Based on improved performance at the time, RentACenter opted to not extend the notice on their end and then requested a reverse breakup fee of $126.5 million. So pretty much the minute the deal was broken off, the share price increased, and today it's around $26.76 per share. So that, again, that's $26 per share. Safe to say shareholders are pretty pleased that the deal never went through. I talk about what was the value proposition there. Well, the value proposition was not actually executing any deal at all. And so they end up getting a little bit of cash up front, and they end up streamlining different parts of their businesses, which is what we're going to be talking about now. Also, this is going to be a very important piece of the puzzle for them in terms of the competitive landscape. RentACenter is the center of their own buyout, basically entering into a definitive agreement to acquire Merchants Preferred. Merchants Preferred is a virtual rent-to-own provider similar to Aaron's progressive leasing program. We talk about them partnering with Big Lots in the past, and RentACenter's current Acceptance Now platform. The deal breaks down to around $28 million in cash for those wondering, and around 701,000 shares of RentACenter common stock, valued at around $47.5 million if you do the math as of market close on July 12th. If RentACenter already has a platform for virtual leasing, Trent, you really have to question, why make this purchase now?
And I think that's a valid question, but for one, the purchase price of this deal is fairly low, so it's a low-risk deal here. But they also feel like, in this circumstance, Merchants Preferred has greater inroads with some retailers that are out there, and also maybe a better IT infrastructure. And a lot of it that was mentioned during the press release, but also in different comments to media, surrounded the technological capabilities of Merchants Preferred, which partners with around 2,500 locations currently. Now, again, you're looking at third-party retailers, so Merchants Preferred isn't a retailer themselves, but they partner with around 2,500 other locations, whether that be from independent retailers, chain retailers, and the like for these virtual rent-to-own services. RentACenter, to put it in perspective, only has Acceptance Now kiosks themselves in around 1,100 locations as of the release. So this is going to grow their program by several times, more than 2 times. In fact, in terms of size, you'd be looking at maybe about 3,600 locations in the future, and that's before any expansion. It seems implied that Merchants Preferred is a bit ahead of Acceptance Now also in terms of the platform build out and in terms of the strength of their partnerships they have with retailers. But as I mentioned, $47.5 million seems like a relatively small amount for the company. But what we don't know from this is what kind of debt Merchants Preferred has. There's no specific mention in the official release. One thing RentACenter's leadership did note about the deal, it brings the potential for growth outside the furniture and electronic silos that RentACenter currently specializes in. And this is an interesting part of the deal as many mainstream retailers look to outsource their rent-to-own solutions. We spoke of Best Buy adding Progressive Leasing as a partner this year. RentACenter is hoping this deal will make them more appealing to other retailers in their endeavors to adopt similar technology. They plan on offering both self-service, which is the current case with their kiosks, and also hybrid models or partially staffed models in these retailers in the future. Now, for years, retailers have had layaway or financing platforms, but adding rent-to-own gives them kind of another bullet in their gun, so to speak, especially for what are termed non-prime customers. So these are customers that aren't really going to qualify for the in-store financing, and they might want use of the product before it's entirely paid for. So unlike on a layaway platform, this customer might be, say, buying a couch. They can't get, for whatever reason, the in-store financing, whether that's because of credit score or lack of banking history or maybe no current banking history or no current bank that they bank at traditionally. But they might qualify for some of these platforms to be able to rent to own through a Progressive Leasing or through RentACenter's own Acceptance Now program. So that's basically what you're looking at, is you're giving the customer the item up front, but you're getting money from them, and you're getting more money from them ultimately than if they were to purchase the item outright. Now, some of that money, of course, is going to go to that third-party platform, and some of that money will go into your pockets if you're a retailer. Now, in theory, because of this, the old layaway departments in most stores may vanish altogether soon. Several already have. This is something that not a lot of the younger customer demographic is using as it stands. And part of this is just the decades-long erosion of the layaway platform because credit is so available. But even for these non-prime customers now, there are more solutions around that give customers use of the product up front. Now, anything that can decrease the number of turned-away customers for big-ticket items results in an immediate top-line bump for mainline retailers. So a big reason why a lot of these larger retailers, Layton mentioned Big Lots, Best Buy is another one that's partnered up with these third-party platforms. Big reason why they're doing this. Now, the main question going forward for RentACenter's Acceptance Now platform, now that they've brought another company and Merchants Preferred into the fold, which retailers will want in on their business? Now, it might be limited somewhat by the fact that several retailers of big-ticket items have already shuttered their doors. Think H.H. Gregg, for example. And those like Walmart and Target would likely want to adopt platforms in-house instead to try and keep as much of that money in-house. However, in-house programs, of course, they can be pricey, and because Acceptance Now would service unbanked customers, or what are specifically mentioned as unbanked customers, customers without a traditional bank account during the deal, might be more appealing to outsource and just kind of let those third parties deal with the hassle. So a lot of stuff going on here. Obviously, for RentACenter, it's going to put them in a more advantageous position going forward to offer these third-party services, but it gives another company out there for retailers to partner with to try and bring in some of those larger ticket customers.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment on the Retail Focus podcast, a segment we call Looking Ahead, where each Layton and I take a look ahead, one story we're keeping an eye on for the next week, month, or year. I'll go ahead and start this week. I'm looking ahead towards GNC. The company has their earnings call coming up on Monday for their second quarter, and one of the reasons I'm looking ahead to GNC is, to be quite frank, their last earnings call was bad. E-commerce sales, which the company has been trumpeting under this one new GNC platform, saying we're going to get better in e-commerce, this, that, and the other thing, they were only up about 4% over the same quarter last year. Same-store sales were down. Combine those with the fact that a lot of their own stores are closing, a lot of their franchised outlets through Rite Aid stores were closing because Rite Aid was closing a lot of stores or selling them off. You had negative sales numbers for GNC. The reason I'm looking ahead to the earnings call, though, GNC has basically done, I mean, in my opinion at least, just about everything they could have done wrong, they've done wrong. They partnered with Amazon. That was a big thing. Lots of press releases a few years ago about their products being available on Amazon. Last quarter, they started having to peel away some products from Amazon because they weren't high margin enough to overcome the prime shipping options as Amazon was fulfilling it. So the price that Amazon was charging to fulfill these items wasn't making it worth GNC's time. So they had to relook at everything that they were selling through the Amazon platform, get some of those products off of the platform so they could start pulling in a higher margin. Additionally, they were having all kinds of issues with the products showing up on what they called the gray markets on Amazon. So either knockoff products or other third parties selling the GNC products on Amazon. So they've been working with Amazon to try and deal with that. So the Amazon launch hasn't been altogether successful. Their e-commerce hasn't been altogether successful. When you look at 4% improvement in same-store e-commerce sales or same site sales, if you will, that's not good when you're seeing a landscape where retailers, even the worst ones, even the Bed Bath & Beyonds of the world, are seeing a 7 to 10% increase and you're coming in with 4%. That's not good. Their in-store presence, that's not good as well. When they rolled out the one new GNC, they kind of redid their stores. I was just in a GNC store this week. It was the first time in about 3 years I've been to a GNC, and it was kind of stale. A lot of the products in the store were dusty, and the point of sale process took forever. It took about 5 minutes to get me checked out with one single item, and it's because they had to find my account. They found my account under a different name. They had to go through, refresh the account, take down all of my personal information, including things like zip code and email address. It took forever for the cashier to put it in. And so what should have taken 2 minutes at a GNC instead took about 8 to 10 minutes at the GNC. So their in-store presence isn't good. If you're not a frequent shopper there, it's not something that's attractive to you. How are you going to bring in new customers if your in-store presence is somewhat stale and also a lot of labeling on products? Not only the product labels themselves, but in terms of the shelf signage and that type of thing are vague, and it's difficult to tell what exactly is going to assist you. They don't have a lot of products that are looked to by the new consumer of fitness products. Layton and I were talking before the show. Really, the fitness world has moved away from bodybuilding towards things like CrossFit, cycling, running, all of that. And they haven't really changed their product assortment to reflect that. About 30 to 40% of what GNC sells seems like is protein products for the bodybuilder. When you go in, chances are very good that the clerk is going to look like a bodybuilder. I had a clerk actually ask me if I was purchasing something for the gains. That's not their core customer, or maybe it is their core customer now, but that core customer group is dwindling. So a lot of questions here for GNC. How are they going to bring in new customers? What are they doing with the Amazon project? What are they doing with their e-commerce site? And how does it all tie into the company's profitability? Right now, you've seen their market cap just crumble to where now it's under $150 million as of the time we checked on Friday. So a lot of questions in this earnings call from GNC. I'm not hopeful that we'll get some answers, but I at least want to see one or two things, and I guarantee you it's something we're going to be talking about on next week's podcast.
My looking ahead story has to do with U.S. retail sales of plant-based foods, and this is a story that Trent was actually going to be talking about, but I'm taking over. This is an interesting story claiming that the growth of plant-based foods is actually really outpacing conventional food sales in the United States. So in terms of overall growth, you're looking at around 11%, and this is according to Plant-Based Foods Association, or PBFA, and the Good Food Institute. You look at the data that was released on Tuesday, the associations were basically extremely bullish on the market opportunity for plant-based foods overall. If you look at the dollar sales trend, they certainly are going up significantly year over year. My looking ahead has to revolve around, can this momentum continue? And let's put this in perspective for 1 second. So in April of 2017, it was marked that annualized sales of plant-based food products were $3.4 billion. Now they're around $4.5 billion in April of 2019. Again, according to this study. And you look now, Trent, the overall growth, again, 11% on plant-based foods annualized, all conventional food products, that growth is more or less matching inflation, so around 2%. However, I want to take a bigger picture lens here, and this is why this is my looking ahead, because if you look at the overall amount of grocery sales in the United States, it's around, yes, Trent, $6 trillion. And so we're talking about an absolute number of plant-based food sales hitting around $4.5 billion. Everybody is extremely bullish on plant-based products, plant-based burgers that are now huge thanks to some recent IPOs. But if you look at the overall growth rate of 2% for conventional food products, that is actually not a small number in terms of absolute dollar value, because a 2% increase in a $2 trillion pie means that it's over $4.5 billion in sales. Because if you do the math, if you do the quick math, you can see that $4.5 billion of plant-based foods is actually 0.07% of the overall food market in the United States. So that's extremely small. However, the marketing push behind it is extremely big. This study and others would have you thinking that 30% of overall sales are coming from plant-based foods. The question is, what exactly is the ceiling for plant-based foods, and is it more sustainable? Because overall, if people are eating more meat, let's say, for the years to come, a lot of people are going to be up in arms about the negative effects it could possibly do to the environment. Now with plant-based foods, people are kind of getting around the harm done to the environment in certain scenarios with conventional food processing. So there's a lot of things in here to discuss. And what's interesting to me is what exactly is going to be the advertising take for these different companies that are trying to take advantage of this new and emerging market. So a lot to look forward to, a lot to digest, pun intended. But overall, you're seeing that the market for animal products, including meat, seafood, eggs, and dairy, it is somewhat going down in the face of a lot of plant-based alternatives, especially red meat. Red meat's had a bad rap for quite some time. I know, Trent, you eat a lot less red meat than you used to. I do myself. I maybe eat red meat maybe once every other week or every 3 weeks, but eggs and dairy still being consumed at high levels throughout our consumer economy here in the United States. Still, what plant-based products can mimic those very, very standardized items that have been around in terms of being stapled goods for such a long time, and even have a better taste and maybe have better health consequences upon digesting those versus those other products that are derived from an animal. But as it pertains to my looking ahead, Trent, that is what I am going for this week. I'm very curious to see how this market plays out. Curious to see if the $4.5 billion maybe doesn't exceed $5 billion this next year.
Well, that'll do it for us here on the Retail Focus podcast. For Layton, I'm Trent saying so long until next week. We'll be back about 7 days from now with more retail news and notes.
This has been the Retail Focus podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.